This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
In this lecture, we're going to go through Chapter 13 of the free Paper 2 lecture notes, which, as you can see, is headed up Relevant Cash Flows in DCF, Discounted Cash Flow, including tax and inflation. In the previous chapter, we went through the what you might call the mechanics of discounting, how to actually use the discount tables, dealing with annuities, perpetuities. But a big problem is actually getting the cash flows in the first place. Once we've got the cash flows, it's just applying the rules that were in the previous lecture. And you'll see, if you look at the notes, first of all, it discusses relevant costs, which actually is something that you should already be happy with from paper P1. But when we're doing discounted cash flow, what we're looking for always are the future incremental cash flows. So we're only looking at future flows. Any money we've already spent, it's too late. If we spent the money, we've spent the money. We're looking at what future cash flows will result. Incremental, extra, it's the extra cash flows that result to the company as a whole. And cash flows, we're only concerned with the cash flows in discounted cash flow. We're not interested in non-cash flows such as depreciation. And so that's what we're after. You'll see paragraph 3 says non-relevant costs. You should already be happy again with the terminology, but sunk costs are not relevant. Sunk costs, that's where the money's already been spent. One common example of this, maybe we're thinking of buying a new machine which will cost us 100,000. We've already spent 10,000 doing some market research as to what the future prospects of the machine will be. Well, if we've already spent that 10,000, that's too late. We spent it, whatever happens. What we're concerned with is it worth spending another 100,000 to actually buy the machine? The 10,000 we'd ignore. It's a sunk cost. We've already spent it. Committed costs, as it says there, costs that will be incurred whatever decision we make, are not relevant. An example of this, maybe our business, we already have fixed costs. We have rent, for instance, of 100,000 a year. We're doing, considering buying this new machine. Well, if the new machine increases the rent for any reason, then the extra is relevant, it's incremental. But if there's no increase in the total rent payable, if we're paying the rent anyway, it's not relevant when we come to decide on whether or not to do this new machine. Book values, historic costs, completely irrelevant. We're only interested in actual cash flows. It doesn't matter what we originally paid for things or what they stand at in the statement of financial position, the balance sheet. Non-monetary costs, I've already said, we're not interested in. We're only interested in cash flows. So again, things like depreciation, irrelevant. And finance costs, any interest paid is always irrelevant when looking at the cash flows. Because, and it's something I'll mention again later, the discounting itself is accounting for the interest. That's why we're discounting in the first place. So, although we will be paying interest, obviously, we're not interested when we come to look at the cash flows arising from buying this machine. And so, exercise 1 is really very much a repeat of what you should have done for paper P1. just looking at examples of how we might arrive at the relevant costs. If you have a look with me quickly, it says a research project which to date has cost the company $150,000 is currently under review. If we do allow it to proceed, we'll complete in about a year and we'll sell the results for $300,000. So if we go ahead, we'll get revenue of $300,000. There's then a list of all the costs that are going to be incurred if we go ahead. We'll read them one by one shortly. But it says at the bottom, advise the managing director as to whether or not the project should be allowed to proceed, explaining your reasons for the treatment of each item. So essentially, we're going to look at what cash costs, what future cash costs there'll be if we do this machine. We know we're going to earn $300,000 from it. And so our decision, if it's costing more than $300,000, we'll be losing money, we won't do it. If it's more than 300,000, if it's less than 300,000 rather, the cost, then we will do it. And this one specifically says ignore the time value of money. So as you'll see later, usually we're looking at cash flows over a period, 4 years, 5 years, whatever, and we will discount as we did in the last chapter. And we will do in later exercises in this, in chapter 13. But for this particular example, it's because we're only checking on what we mean by relevant cash flows. We're not actually going to do any discounting. We're going to ignore the cost of money. And so let's have a rundown. What I'm going to do is we'll list all the costs that are involved. We'll add them up and then we'll decide, are we spending more or less than the 300,000 revenue we'll get? So let's go from the top. First line, a research project which has already cost the company $150,000 is currently under review. Well, that's not relevant. We've spent $150,000, and as I've already said, I think twice, we've spent that money whether we go ahead or we don't go ahead. And all we're concerned about is what extra money would we need to spend, and whether that's more or less than the 300,000 we'll earn. So the 150 is a sunk cost, a past cost. It's not relevant. Further down, shown below are the additional expenses which you'll estimate will be necessary. Well, let's go through them one by one. First of all, materials. The materials required have just been purchased at a cost of $60,000. They're toxic, and if they're not used in the project, we must dispose of them at a cost of $5,000. Now, this is a rather unusual one. Check the wording carefully with me. The materials, we've already purchased them. So again, it's a sunk cost. We've spent that $60,000 whether or not I do the project. So the $60,000 itself is irrelevant. However, they are toxic, and if we don't use them in the project, we'll dispose of them at a cost of $5,000. Now, what makes this a funny one? If we do the project, fine, we'll use the materials. We don't have to spend anything. We've already paid for them. And if we use them in the project, we're not going to dispose of them. But if we don't do the project, if they're not used, we have to dispose of them and it'll cost us $5,000. So if we don't do the project, we'll have to spend $5,000 getting rid of the materials. If we do the project, we won't have to spend the $5,000. So doing the project will save us $5,000. And that's what makes it odd. Actually, I'm listing all the costs involved, but in fact, using these materials won't cost us anything. It'll save us money. It's like a negative cost. We've got the saved disposal costs, $5,000, I'm showing it as negative because it's a negative cost. We're saving money. Again, doing the project will spend nothing. We just use these materials. Not doing it, we'd have to spend 5,000 to remove them. But it's a saving. Next one, labour. Quite a bit to read here. Skilled labour is hard to recruit. The workers concerned have been transferred to this project from a production department, and the production manager claims that if the men were returned to him, they could generate sales of 150,000 next year. So by using these men, we'll be losing the sales we could have made of 150,000. The prime cost of these sales would be 100,000, including 40,000 for the labour itself. Now you should be aware from earlier studies that the prime cost is the name we give to materials and labour. So think about this. What's happening at the moment? If these men aren't used in the contract, they'll be generating sales revenue of, what is it? 150,000. And in order to make them, we'd be paying labour of 40,000. And we'd be paying materials. Well, it says the prime cost will be 100, including 40 for labour. So the materials must be the remaining 60. So if we don't do the contract, that's what will be happening. We'll be earning 150 revenue. We'll be paying 40. We'll be paying 60. What's going to happen if we do the contract? Well, if we do the contract, we're going to lose that revenue. Doing the contract, we'll still be paying the labour. They're paid 40,000, and we'll be paying them the same whether they work on the contract or whether they go back to the other work. But materials, well, if we take them for the contract, all right, we don't make those other goods, so we don't get the revenue, but of course, we'd no longer need to pay for the materials. And so, if we move the men to work on this contract, what effect does it have on the business? Again, we lose that revenue, we save those materials, and therefore we lose 90,000. It's effectively, therefore, costing us 90,000 for this bit of it to do the contract. That, you should remember again from earlier studies, we call an opportunity cost. Because we're not directly spending 90, obviously. But the reason it's costing us 90 to do the contract is because we're losing a net 90 that we could have earned if we didn't do the contract. There is one more bit here, which I've ignored so far. It says the last sentence under labour, it says the overhead absorbed into this production would amount to 20,000. Well, again, remember, if we absorb overheads, we're simply charging overheads. And that in itself is not relevant. You see, our total overheads for the whole business could be, let's say, 100,000. For profit purposes, we can charge that between all our different projects. We can charge it any way we want. But all we're concerned with here is if we do the contract, will there be extra costs involved for the business? And simply absorbing overheads doesn't mean we're actually spending any more. If the question had said total overheads increased by 20,000, then it would be relevant. It's an extra, an incremental cost. But simply absorbing them, that implies the total overheads are unchanged and therefore not relevant. Let's carry on. What about research staff? What does it say here? It's already been decided that when work on this project ceases, we will close our research department. Research wages for the year are 60,000. Let's stop there for a moment. The wages will be 60,000, and remember, it did say at the very top, the second line of the question, the project, if it goes ahead, will be completed in 1 year's time. Well, I think this is an easy one. The wages, surely. If we stop now, we won't pay them any more wages. If we do go ahead, we'll have to pay them wages for the year of 60,000. And therefore, there is an extra cost of going ahead. In addition, there's redundancy and severance pay. Now remember, we're going to cease close the research department. If we close it now, we'll have to pay them 15,000 severance pay. But if we go ahead, in which case we don't close it until a year's time, we'll have to pay them 35. Well, again, we're interested in the extra cost of going ahead with the contract. And so the relevant cost is the extra redundancy pay. We're paying 15 if we went now, but it's 35 if we go in a year. So to continue, it'll cost us an extra 20,000. Next one, equipment. The project uses a special microscope which cost 18,000 3 years ago. Irrelevant. We've already spent that money. It was 3 years ago. We've spent that 18, whether we continue or we don't. It's got a residual value of 3,000 in another 2 years. Well, not relevant. We're not going to carry on for 2 years. We either stop now or we do the contract and it takes 1 year, we finish in a year. It's got a current disposal value of 8,000. And if used in the project, it's estimated that its value in a year's time will only be 6,000. So what extra costs are there of doing the contract? If we don't do the contract, we'll sell now and we'll receive 8,000. If we do the project, we won't sell now, we'll sell in a year's time, but we'll only get 6,000. And so doing the contract is losing us that difference of 2,000. It's either 8,000 now, if we don't go ahead, 6,000 in a year if we do go ahead. It's costing us the difference of 2,000. So what is it? The equipment. Getting 6,000 instead of 8,000, the difference is costing us 2,000. And again, that's not a direct cost, obviously. We're not actually paying anything out. It's lost income. We either get 8 or 6. By carrying on, we lose income of 2,000. As I said, again, it's an opportunity cost. Lost income. Finally, share of general business services, building services, sorry. The project is charged with 35,000 a year to cover its share of general building expenses. Well, that's very similar to when I mentioned overheads earlier on. For profit purposes, if we've got several projects, several departments, whatever, We can charge them all separately with a share of the total fixed costs, the general building expenses. But I don't care how we charge them for profit purposes. We need to know what extra cash flows will there be if we go ahead with this project. And simply sharing the expenses differently does not imply that we're actually spending any more. That would only be relevant if it actually said, oh, doing this contract will mean we spend an extra 10,000, 20,000, whatever. So just a share is completely irrelevant. But what about the next bit? Immediately the project is discontinued, the space occupied by the project could be sublet for an annual rental of 7,000. And so as soon as we stop the project, we'll let it out and we'll earn 7,000 a year. This project will take a year. If we don't do it, we will earn rent of 7,000 next year. If we do the project, then of course we can't rent it out next year. We won't receive the 7,000. And so it's yet another opportunity cost. If we go ahead, we'll lose rental for 1 year. And how much will we be losing? 7,000. So again, it's not a direct cost. We're not paying 7,000 if we go ahead. But it's relevant because the business will lose 7,000 income they could have earned if they didn't go ahead. And so there we are. The question specifically says here, as I said at the beginning, it specifically says ignore the time value of money. So although later in the chapter, when we come to look at fuller questions, we will take account of the fact that, some of the costs may be in a year's time and we need to discount. But for this one, irrelevant. And if we're ignoring money, what is the total cost of doing it? 90, 150, 170, 172, 179, less that saving of 5. I get a total of 174,000. And the decision now, of course, is obvious. In cash terms, going ahead will cost us 174. How much is it going to earn? In the second sentence at the top of the question, it'll earn us 300,000. And so, of course, is it worth going ahead? The answer is yes. Do proceed. And there we are. So, as I said at the beginning, that really should have been revision of previous studies, but do make sure, because in the rest of the chapter, when we come to full exercises where we're looking for cash flows over several years, any of or all of those sorts of costs could be involved. And so I hope we're clear from that example, if I finish this bit of the lecture as I started, what we're after is the future incremental or extra cash flows. All right, there's quite a bit more in this chapter, but we'll pause there. In the next lecture on this chapter, I'll go through working capital, inflation and tax, which is what turns it into what you might call a full discounted cash flow question. That's something for you to look forward to.